There are over 150 million Americans who don't invest. But here's the kicker. If they just started with $50, that they could be growing real wealth right now instead of wondering where all their money keeps disappearing to. You don't need a finance degree. You don't need a six-figure salary. And no, you don't need to sell a kidney on Craigslist. You just need this video. Because I'm about to show you how to build your very first investment portfolio with just 50 bucks. Disclaimer. This isn't financial advice, it's educational and for entertainment only. But let's be honest, it'll probably do more for your money than your last 47 TikToks. Let's get to it. 1. The invisible investment trick. You're probably already doing this. Imagine if every time you bought a coffee, you accidentally became a shareholder. That's the whole game behind micro-investing. Apps like Acorns, Stash, and Round, up your spare change from everyday purchases and automatically invest it into diversified portfolios, usually built from ETFs or index funds. Buy a burger for $9.45. They round it to $10 and drop that extra 55 cents into investments. Doesn't sound like much? That's the point. You don't feel it. But over time, that invisible money starts doing visible work. Let's say you spend $15 a day on food, gas, and random snacks. That's around 75 cents in spare change daily. Or $22 a month. Compound that over 5 years, reinvest dividends, and that change adds up to real capital. This is the set it and forget it warm-up round for anyone afraid to dive in. You're building muscle memory without even noticing. Perfect for college students, first-time job holders, or literally anyone who says, I just don't know where to start. Ready to get a little more hands-on? Let's talk about owning big-name stocks with baby-sized budgets. 2. You don't need $300 to own Apple. You need this. Old investing logic, you need hundreds of dollars to buy a single share of Apple. New logic, you need $1 and a decent Wi-Fi signal. Thanks to fractional shares, you can own a sliver of any stock, no matter how expensive it is. Want to own Amazon at $3,500 a share? Buy $10 worth. You'll get a piece of the pie and still afford lunch. This isn't just a gimmick. It's a game changer. Before this, high-value companies were locked behind a velvet rope for anyone without major capital. Now, you can be part of the same companies leading global innovation without skipping rent. You're not just watching Tesla Moon anymore, you're going along for the ride. And when you're ready to build a portfolio, $50 gets you exposure to 5 to 10 blue-chip giants you actually believe in. Spread it across sectors, tech, consumer goods, energy, and you're already ahead of 90% of people who only invest in hype coins and hope. But what if you want even more variety for your money? Let's multiply that $50 across dozens of companies at once. Third instant diversification on a dime. You wouldn't bet your entire paycheck on one horse at the racetrack. So why invest in just one stock? ETFs, exchange-traded funds, are bundles of stocks you can buy as a single unit. Think of it like a smoothie. One sip gives you a little bit of everything. Apple, Microsoft, Netflix, Home Depot, and more. All in one blend. For just $50, you can own a fraction of an ETF that holds hundreds of companies. The S&P 500 ETFs like SPY or VOOO let you tap into the performance of America's top 500 companies with one trade. The result? Instant diversification. One bad stock won't tank your whole investment. ETFs are the cheat code for beginners. They lower your risk, reduce the pressure of choosing winners, and still let you benefit from long-term market growth. Pro tip: focus on low-fee ETFs. That way, more of your money is working for you, not lining someone else's pocket. But what if your money could earn more money, even while you sleep? Let's turn that $50 into a passive income machine. Fourth, dividend stocks. Because getting paid to hold is a vibe. What if your money could pay you just for existing? Enter dividend stocks, companies that literally send you cash, quarterly or monthly, just for owning a piece of them. They're like that one responsible friend who always pays you back, but these companies have billion-dollar balance sheets. Let's say you buy a share of Coca-Cola or Procter& Gamble. You'll earn a dividend, maybe 40 cents a share, just for holding it. Now imagine reinvesting that money into more shares and earning dividends on those and repeating it for 10 years. That's the power of compounding. You're building a snowball that rolls downhill and gets bigger without lifting a finger. And no, you don't need thousands to start. With fractional shares, you can buy $10 of a dividend stock and get a small slice of that passive income life. Dividends turn your portfolio into a tiny, self-sustaining cash machine, even when the market's flat. But let's say you don't have time to pick stocks or read 10 earnings reports. No problem. There's a tech shortcut for that. 5. Robo Advisors. The lazy genius way to invest. Let's be real, not everyone wants to become the next Warren Buffett. Some of us just want the grown-up version of autopilot. Enter robo-advisors like Betterment, Wealthfront, and SoFi Invest. These platforms ask you a few questions. How old are you? When do you want your money? Do you panic when the market dips 5%? Then they build and manage a personalized portfolio for you, using algorithms smarter than your cousin Dave, who keeps buying the dip into oblivion. You can start with as little as $5 or $10. Your money goes into a mix of ETFs based on your goals, and the robo does the heavy lifting, balancing, reinvesting, optimizing, and keeping emotions out of it. Think of it like your digital financial sidekick, minus the judgment. If you're someone who wants results but doesn't love spreadsheets, this is your golden ticket. Say hello in the comments if this sounds like something you'd actually use. Because next, we're talking about something even safer than stocks. 6. The slow but steady safety net. Not technically investing, but crucial for anyone building financial momentum. A high-yield savings account, HYSA, is your financial safety net. A place to store cash where it actually earns interest. We're talking 4% APY or more, compared to the 0.01% most brick-and-mortar banks give you. Online banks like Ally, Marcus, Capital One, and SoFi are leading the charge here. Open an account, drop your $50 in, and watch it slowly but safely grow, without risking a market crash wiping it out. Use it to build your emergency fund, or stash away money while you figure out your next investment move. The key here isn't huge return swiping, it's accessibility and peace of mind. When the stock market's freaking out, your HYSA is quietly earning interest like a well-behaved honor student. But before you invest a single cent more, there's one thing you absolutely have to do. 7. Learn before you launch. Seriously, if you don't understand where your money's going, you're not investing, you're just guessing with extra steps. Before you pour that $50 into the market, learn the basics, how risk works, what makes a good investment, why diversification matters, the difference between growth and income strategies. Free resources are everywhere. Investopedia for definitions, YouTube for walkthroughs, Coursera/Udemy for structured courses, podcasts like Bigger Pockets Money or The College Investor. The more you know, the more confident you'll be, and confidence kills panic. It also helps you spot hype from actual opportunities. Treat your brain like your portfolio and invest in it early and often. And now that you're educated, let's talk about how to lock this in and build real momentum. 8. The real secret to growth? Set it and forget it. Timing the market is like trying to predict which squirrel will cross the road first. Instead of guessing, automate. Most platforms let you set up recurring deposits, $5, $10, or $20 a week, straight from your checking account. This is called dollar cost averaging. You buy in small chunks, regardless of whether the market is up or down. It removes emotion, it builds habit, and it eliminates the should I wait for a dip paralysis. Even better, automation makes your investing boring, and boring is beautiful. Because boring is where real money compounds. You don't need willpower, you need systems. And speaking of patience, here's the truth most people ignore. 9. The boring stuff is what actually works. Here's a cold truth. 90% of your results in investing come from not quitting too early. The secret weapon? Compound interest. It's not flashy. It doesn't moon. but it's been silently building fortunes for centuries. Here's how it works. You earn returns on your money, then returns on those returns, then again and again. Let's say you invest $50 every month into the S&P 500. After 10 years with an 8% annual return, you'll have over $9,000. And you only contributed $6,000. That extra $3,000? Compound interest, passive growth, patience paid off. The best investors aren't psychic. They're just consistent, disciplined, and incredibly boring. Investing isn't a sprint. It's a slow, powerful crawl that turns into a sprint at the finish line. If you just keep going. So there you go. 9 ways to turn your first $50 into something powerful. A foundation, a strategy, a portfolio. You don't need big money. You just need smart money habits. And now you've got them. If you learned something today, smash that like button like it's a buy confirmation screen. Subscribe for more no-fluff finance content that actually helps you grow. And if you've already started investing, drop your favorite beginner platform down in the comments. Now go invest that $50 yuan and let the future version of you say thanks.